Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on April 29th. At the time of this recording, it is Thursday, April 28th. So my name is Ian Saunders, and joined here today by John Lewis, who's a portfolio manager and the head of the research here at Dorsey Wright. So blessed to be joined by him. John, thank you for coming on today.
Yeah, thanks for having me on.
Yeah, so there's a lot going on in equity markets over the course of the past few weeks, really a lot going on in markets in general. Wanted to kick things off just giving a brief index update with market movement at the time of this recording on Thursday, April 28th. We're seeing a bit of a pretty substantial pickup for some of those core domestic equity indices. So just diving into that 25-point chart of the S&P 500 index, we did see that chart move lower and give a sell signal last week there at a chart level of 43.50 on that 25-point chart. Seeing that tick a little bit low, and it found pretty notable support at the 41.75 point. Formed a spread triple bottom at that level. And then with today's movement, we're seeing a reversal back up into a column of X's. So that support did hold, and we're seeing a current chart position there at 42.75. So seen a lot of kind of back and forth movement over the course of the past several weeks. Obviously, a lot of downturn over the course of the first quarter of this year, a little bit of an uptick to end of that first quarter. And now into April, we've seen some negative movement here as well. So we thought that there's kind of no better perspective or no better commentary that could be had by having John Lewis come on and chat with us here this afternoon. So John, I mean, in coming in and taking a look at some of these changes, a lot of change over the course of the past few months here. And I'm sure we've seen some of those same changes take effect in many of the portfolios on that domestic equity side of things.
Yeah, for sure. So there's been, like you said, a ton of changes in terms of where the leadership is, and not necessarily from an asset class level so much as kind of underneath the surface. So, we've been talking about that Dolly asset allocation model for a long time, having commodities number one, domestic equities number two, international number three. But that really hasn't changed. But especially on the domestic equity side, we've seen a huge rotation out of that old leadership, that old kind of large cap growth tech theme and consumer cyclicals theme, and into a lot of other areas that really have been out of favor for a while. So that would be things like energy, things like basic materials, and then even like financials, banks, that sort of thing. So that's certainly not what's going on today, but for the last couple months, that's really been the leadership rather than what we've seen for the past, 3-5 years, which is that kind of large cap growth tech theme.
Yeah, certainly. I mean, you've seen that play out, like you said, across many of the rankings that we have on the platform. And I mean, some of those rankings are going to move a little bit quicker than others. But I mean, there's been a lot of talk, I guess a lot of people, like you said, that technology growth theme has been that area that's been in favor for so long. And people are continuing to kind of wait to buy the dip there. I mean, they're looking at, is it time to jump back into this name? Is it time to jump back into this high growth area? When you see, especially on a day like today, when you see a big update. And so when you're seeing these changes take place, I mean, some of the changes that we've seen, are those tend to be kind of more that shorter term in nature theme, or those themes kind of tend to persist across a prolonged period of time?
Well, I think a lot of times they're kind of short term in nature, and this environment, like you mentioned, like people are waiting, like, hey, when should I buy this stuff? This reminds me a lot of like 2000 into 2001, where tech was unwinding, and then everyone just wanted to buy the dip, and the dips kept coming, and it didn't push back to new highs. So I don't want to make it sound like I'm saying we're heading into that same type of market, but what I mean is the sentiment is very similar there. So I think we'll probably get some of that, right? We'll get some of these big rallies that you see a lot of times with the laggards, right? These laggards have these big rallies that are often short-term in nature, and then you kind of go back to that old leadership. So in terms of like portfolio management and what you want to do with your own portfolio, your clients' portfolios, that kind of thing, I think you really need to see some prolonged strength in these things, right? Like this one day shouldn't really make that much of a difference. You need to see some big outperformance that's sustained over a little bit of time, and that kind of starts showing up in the indicators, in all these momentum indicators, whether you're using like technical attributes or just like a 12-1 momentum or a matrix or, whatever you're using, this stuff starts to show up. And until it kind of gets to the top of the ranks, I think there's just a lot of noise and a lot of back and forth going on.
Yes, certainly. And I mean, one area that has risen to the top of the ranks, as you said, has been energy. And a lot of that has been kind of dependent or indicative of that major rally that we've seen in crude oil, right? I mean, we had crude oil rally substantially over the first few months of this year. I mean, topping out at a chart position for those following along on the platform, that CL forward / crude oil continuous chart topping out at that chart level of 130. And it's retracted pretty substantially there to kind of touch right up against that bullish support line at a current chart position of 102 before movement today. When looking at crude oil and energy, John, I know we've talked a lot here at Dorsey on the research team about we're still seeing a rising dollar, but we're not seeing the rising dollar kind of affect a lot of those commodity prices. I mean, you seeing that kind of play more of an effect as we head through the rest of the year, or what are things looking like for you?
Yeah, I mean, a rising dollar is definitely a headwind for commodities and international equities. So we've seen that headwind more in the international equity space, with that being kind of number 3 in Dolly, and it hasn't really moved a whole lot. But in terms of the commodity space, right, it's just blown right through that rising dollar theme. So a lot of these energy stocks, I think, look really good. Yeah, like you said, crude oil, it's been pretty volatile, but we are trading at much higher levels than we were a few years ago. And I think there's something else to consider with energy and a lot of the energy stocks too, in that these things go through some really big cycles where they have dramatic outperformance. There was some in the 70s, some like mid 2000s. We might be seeing that again. Those lasted like 5 to 7 years. I'm not saying there wasn't a lot of volatility in them, but these things can run for quite some time. And energy was so beat up. I think it was maybe, I don't know, a year and a half ago, energy had fallen all the way down to, if you looked at it on a relative basis, I think it was versus the S&P 500, you had made no headway since like 1995, right? So, I mean, that's a pretty significant fall. And we got to the point where energy was like, 2.5% of the S&P or something like that, to the point where portfolio managers were kind of the mindset that like, whatever, it's only 2.5% of the benchmark, right? But now, like, we're starting to see this dramatic performance. People had like no weight there. And now they're starting to realize like, oh yeah, we need some stuff there. So this cycle can run for probably a long time. It's not to say it absolutely will, but we could be just in the early stages of it. And it's going to be volatile though. I mean, right, this stuff, these kind of commodity plays are always volatile on the way up. But that doesn't mean you can't really make significant amounts of money in these stocks if that trend continues.
Yeah, certainly. I mean, I saw a stat rolling around. I think that energy exposure within like the broader S&P, I mean, it's risen substantially with that rise in a lot of those energy stocks. And that's also an area where certainly those momentum strategies have kind of more potential to outperform because they can have overexposure to those areas or those sectors, right?
Yeah. So when some of these smaller areas in the market do really well, like materials and energy, momentum strategies are usually pretty good at finding that stuff and finding the themes. So I think in the analyst rundown that we did yesterday, if you guys, anyone on the podcast wants to listen to that, we talked in the industrial section about 2 plays that look really good that are really kind of related back to that base of materials energy theme, right? So a company that makes products, right, for agricultural stuff, and then a company that does engineering work for energy companies, so those themes kind of run through a lot of the different macro sectors. Momentum's really good at finding them. And when they're smaller sectors like that, that provides a lot of juice for the overweight, rather than like when tech is going, it's really hard to get these huge, massive overweights to tech just because it's already so big a part of the portfolio. And you kind of really run the risk of getting super narrow and not diversified in the portfolio.
Definitely makes sense. And I mean, I know you touched on too, I mean, back with the energy plan, back with that US dollar, you said I mean, it has provided or seen more headwinds, certainly in that international equity space versus many other areas. And we've seen, I mean, the international equity space as a whole has certainly had a pretty difficult past several months. But there are some areas, maybe on the back of some of this commodity space, that are showing a little bit of improvement. I know you and I have talked about Latin America kind of showing a bit of a pickup, and we've seen that reflected. What do you think that's solely because of the kind of commodity side of the coin, or maybe just it's not China, or what is it there?
Yeah, I mean, it could be a commodity play, and that certainly don't discount that. But I think it's not China is a very good point, and I think it's not Russia, Ukraine centric either. I think is a good point. Like we've had some problems in some of the European bank stocks, for example, right? Like, they've got exposure all these different places, and with all the sanctions and this kind of stuff, that's it's an issue for them. And so I don't think you're seeing the same thing out of a lot of the Latin American companies and that sort of thing. So I think we've seen allocation move over there. And then we've also seen the same sort of shifts internationally in terms of sectors that we have on the domestic side. So, more into energy, more into materials, that sort of thing, tech coming out. So that pattern is the same, but I think what's different is, like you mentioned, like there's the country and region stuff is a lot different, and probably not what people would expect right now.
Definitely be interesting to see how that continues to play out through the rest of the year here. I mean, in looking across other aspects there too. I mean, there's a lot of different things to look at, right, John? There always is. But it's great to be able to kind of dive into things here, whether it's looking at strength that we've seen over the past few months or weakness, and then how we can kind of take that and move out throughout the rest of the year. I know one kind of final point to touch on, looking at we're coming up to the end of April here, right? And we're coming up to that seasonal shift in the market environment, right? I mean, there's always that old market adage of sell in May and go away. And coming back in November, I guess everyone wants to leave the office and go to the beach, but not as many people are in the office today anyway. So do you still see that having as much of an effect as it might have previously?
Well, yeah, that's a good question. I mean, probably not, although I think that we're going to have some sort of event in the future. I'm not saying this year, but that will like bring that kind of old adage back to light. Like Wall Street loves nothing more than a catchy phrase, and whether it kind of works or not is almost irrelevant. So I think, sell in May and go away is super catchy. People always remember it, but there's been a couple big problems during that time period, which everyone kind of refers back to, but it's a really difficult timing mechanism to use year after year after year, right? Because a lot of years nothing happens, and a lot of years you'd be just fine. And so I think that kind of calendar-based stuff like that, while interesting, when you're really doing portfolio management work and you're really dealing with client money and all the issues that go along with that, I mean, yeah, I think you need to be a little more market-centric. You need to look kind of at what's going on. And if you want to kind of keep that in your back pocket, fine. But if things look good, then I don't see any reason to sell, because not only then are you exposing yourself to, like, if the market does well, but then you're paying all the taxes to do that. And so that's not fun either. The government's taken enough of your money as it is. You might as well keep as much as you can. So, I think people forget about that too. Like, there's a lot of consequences with that kind of stuff. So that's why I think we just mainly, focus on these market-based indicators. And if we have to sell based on that kind of stuff, we will. But the kind of calendar stuff doesn't really enter into a whole lot of what we do, only because it really is kind of a complicated thing to do it that way. And it's really hard to manage the clients too when you're doing that kind of thing.
Yeah. And sticking with the indicators, sticking with the game plan, I know that's a theme that we've heard frequently mentioned around here. And we'll do our best to try to continue to keep everyone listening up to date with these indicator shifts, these index shifts. I mean, a lot of stuff moving around in the markets over the course of the past couple of weeks, couple months, like we've touched on here. And we'll do our best to continue to keep you all up to date with any movements moving forward. I do want to throw one final shout out for those listening that do want to talk with us, maybe in person instead of listening to us talk here on the podcast. We are going to be doing a spring symposium out in Las Vegas. So a lot of sign up information for that available on our website. That's at oxlive.dorseyright.com. And if you have any other kind of questions around that, it's going to be May 19th and 20th out in Las Vegas, Nevada. So please feel free to come and learn more for us, ask us questions, and we'll be hope to make that a great event. I'm looking forward to seeing some more people in person there. So but John and I will be out there, and we're looking forward to seeing everybody there. And with that, that wraps up most of what we were looking to cover here this week. So John, thank you again for joining us, and for everybody listening, thank you very much for tuning in this week, and we will be back to talk to you all next week.